For decades, the United States has operated under the assumption that the ultimate purpose of the economy is to generate and maximize profits with the expectation that the benefits will trickle down to the rest of society. This belief has shaped tax policy, corporate governance, labor law, and trade agreements, all with the aim of creating an environment where private wealth accumulation takes precedence over social investment. In practice, this has meant that decisions affecting millions of lives are made with quarterly earnings reports as the central guiding principle rather than the health, stability, and well-being of the population. By elevating profits above all else, industries have consistently chosen cost, cutting measures that degrade the quality of life for workers and communities. Wages are suppressed to increase margins even as productivity rises. Employee benefits are reduced or eliminated in favor of temporary contracts, part-time positions, and gig work that shift economic risk from the employer to the individual. Factories and offices are closed not because a company is failing, but because relocating production to a country with cheaper labor can boost stock prices and executive bonuses. In this framework, the human cost is treated as an external factor, invisible in the official balance sheets, but painfully real in the lives of those affected. The prioritization of profits over public well-being also manifests in the deliberate erosion of public goods. Healthcare, education, housing, and infrastructure are treated less as essential rights and more as market commodities to be bought and sold. When profits become the primary metric of success, there is little incentive to ensure these services are affordable, accessible, or equitable. This has led to a nation where medical bankruptcy is common, student debt is crushing, and millions are one rent increase away from eviction, conditions that weaken the very social fabric a functioning economy requires. This approach has been justified through decades of political rhetoric, insisting that a thriving corporate sector naturally produces widespread prosperity. However, the data show otherwise. Productivity has grown steadily while real wages for the majority have stagnated, and the gains have been overwhelmingly concentrated at the top. In other words, the promise that prioritizing profits would automatically serve the public good has not been fulfilled. Instead, it has created a feedback loop in which concentrated wealth amplifies the influence of those already benefiting, enabling them to shape policies that further entrench their position. The cultural consequences are equally severe. An economy designed primarily to serve investors fosters a society where human value is often measured by financial output, reducing individuals to their capacity to generate income for someone else. Social trust erodes as inequality widens, and economic security becomes a privilege rather than a shared baseline. This undermines the sense of collective responsibility that is essential in addressing challenges ranging from climate change to public health crises. When the guiding compass of an entire economic system points only toward maximizing profits, it inevitably drifts away from the needs, rights, and dignity of the people it is supposed to serve. The shift toward deregulation and the consolidation of corporate power over policy has been one of the most defining economic and political trends in the United States over the past half century. In the mid-20th century, a series of regulations acted as guardrails to protect workers, consumers, and the environment from the excesses of corporate behavior. These included banking restrictions, antitrust enforcement, labor protections, and environmental safeguards. Over time, however, many of these measures were weakened or dismantled, often under the banner of promoting efficiency, competition, and innovation. The argument presented to the public was that less government oversight would unleash the dynamism of the private sector, but in reality, it allowed a small number of powerful corporations to accumulate unprecedented influence over the rules of the game. As regulatory frameworks were stripped away, industries gained the freedom to shape their markets with minimal accountability. Financial deregulation, for example, removed barriers that had once prevented banks from engaging in risky speculative activities. The repeal of the Glass-Steagall Act in 1999 opened the door for commercial and investment banking to merge, creating massive institutions whose collapse could threaten the entire economy. Similar trends occurred in other sectors. Telecommunications companies secured mergers that reduced competition. Energy firms influenced environmental standards to their advantage, and pharmaceutical giants ensured that patent laws protected their profits long beyond reasonable limits. This erosion of regulatory oversight coincided with an explosion in corporate lobbying. Companies began investing heavily in political campaigns, hiring former government officials to advocate for their interests, and funding think tanks that produced research aligned with their goals. The revolving door between corporate boardrooms and government offices ensured that policy decisions were often informed by the priorities of industry leaders rather than by the needs of the public. Campaign financing laws, particularly after the Citizens United decision in 2010, further amplified corporate political power by allowing virtually unlimited spending to influence elections. The consequences of this dynamic are visible in nearly every policy domain. Environmental regulations are delayed or weakened under pressure from fossil fuel companies. Healthcare legislation is crafted in ways that preserve the pricing power of insurance and pharmaceutical firms. Labor laws are adjusted in ways that make it harder for workers to unionize, while trade agreements are designed to protect corporate intellectual property more vigorously than they protect workers' rights or environmental standards. This is not the result of a neutral, free market process. It is the product of deliberate political engineering by entities whose primary obligation is to their shareholders, not to the broader citizenry. The imbalance of power created by deregulation and corporate dominance over policymaking has reshaped the very nature of democracy in the United States. When the voices that carry the most weight in government belong to those with the deepest pockets, the principle of equal representation is undermined. Policy becomes less about solving shared problems and more about preserving the profitability of those who already hold economic and political advantage. The result is a system in which public needs are consistently subordinated to corporate interests, even when those interests are at odds with the long-term stability and health of society. The deliberate offshoring of jobs and dismantling of secure work in the United States has been one of the most transformative economic shifts in recent history, fundamentally altering the structure of the labor market and the lives of millions of workers. Beginning in earnest in the late 20th century, corporations sought to maximize profits by relocating manufacturing and eventually service jobs to countries where labor costs were a fraction of those in the United States. This was often presented as an inevitable consequence of globalization, framed as a natural step toward efficiency and international competitiveness. In reality, it was a calculated decision to prioritize cost savings for shareholders and executives over the economic stability of American workers and communities. The process began with manufacturing industries, where entire factories were closed and production lines moved overseas to take advantage of lower wages, weaker labor protections, and fewer environmental regulations. Industrial towns that had once thrived on stable, unionized jobs found themselves hollowed out almost overnight. Families who had depended on a single employer for generations were left scrambling, often forced into lower paying, less secure work in retail or service sectors. This shift did not occur because American workers lacked skill or productivity. In fact, productivity remained high, but because corporate leadership identified that the same goods could be produced elsewhere for less, thereby boosting profit margins as technology advanced. Offshoring expanded beyond manufacturing to include white collar and service sector work. Call centers, IT support, and even elements of legal and financial services were relocated to other countries where wages were significantly lower. This trend not only reduced job opportunities in the US, but also put downward pressure on the wages of those who remained. The message to workers was implicit, but clear: accept lower pay and fewer benefits, or your job could be moved abroad. The dismantling of secure work was not limited to offshoring alone. Even jobs that remained within U.S. borders were restructured to minimize long-term employer obligations. Stable, full-time positions with benefits were replaced with temporary contracts, part-time schedules, and gig-based arrangements. Health insurance, pensions, and other benefits that had been standard in many industries were increasingly shifted to the responsibility of the worker. If they were offered at all, union power, which had once served as a counterbalance to corporate influence and a defender of job security, was systematically weakened through both legal and political means, further eroding workers' ability to negotiate fair terms. The economic consequences of these changes have been profound. Regions that once relied on manufacturing or specialized industries have faced decades of economic stagnation with shrinking tax bases, deteriorating infrastructure, and declining public services. Individuals who lost secure jobs often entered a cycle of underemployment, juggling multiple low-paying positions without stability or a clear path to advancement. At the same time, corporate profits soared, and the wealth generated by reduced labor costs flowed upward, concentrating in the hands of executives and investors rather than being distributed across the communities that had sustained these industries for generations. The rise of explosive inequality in the United States, the resulting political capture by the wealthy, represent a transformation of both the economy and the democratic process. Over the past several decades, the gap between the richest households and the rest of the population has widened to levels not seen since the Gilded Age. This inequality is not merely a byproduct of market forces, it is the result of deliberate policy choices in taxation, labor law, trade, and corporate regulation that have disproportionately benefited those at the top. The wealthiest Americans have not only accumulated vast fortunes, but have also used that wealth to shape the rules under which the economy operates, ensuring that their position remains secure and increasingly insulated from public challenge. Tax policy has played a central role in this dynamic. Successive reductions in top income tax rates, cuts to capital gains taxes, and the erosion of the estate tax have allowed the richest households to retain more of their income and wealth. Meanwhile, the tax burden on working and middle class Americans, especially through payroll taxes and consumption taxes, has remained steady or increased. This has created a system in which wealth grows exponentially for a small minority, while the majority struggle to keep pace with rising costs of living and stagnant wages. The political consequences of this concentration of wealth are profound. Wealth buys influence, and influence ensures the preservation of wealth through campaign contributions, political action committees, and direct lobbying. The richest individuals and corporations are able to shape legislation, regulatory frameworks, and even judicial appointments. The result is a feedback loop in which the political system becomes increasingly responsive to the interests of the wealthy while neglecting or ignoring the needs of the broader population. This political capture is evident in policy outcomes across multiple sectors. Financial regulation is often written in ways that protect the profitability of large banks while leaving consumers vulnerable to predatory practices. Healthcare laws are influenced by pharmaceutical and insurance companies that prioritize profits over affordability and accessibility. Labor laws are structured to make unionization difficult, limiting workers' ability to negotiate for better wages and conditions. Environmental policies are watered down under pressure from fossil fuel and industrial lobbies, even in the face of mounting evidence of climate change's severe consequences. The social implications of this inequality and political capture are far reaching. As wealth becomes increasingly concentrated, opportunities for upward mobility diminish. Educational disparities widen as affluent families can afford better schools, tutors, and extracurricular resources, while lower income families face underfunded public education systems. Housing markets become distorted as wealthy investors purchase properties as assets rather than homes, driving up prices and pushing working families out of desirable areas. The justice system reflects these disparities as well, with well-funded defendants able to navigate legal challenges more effectively than those with limited means. Over time, this combination of economic inequality and political influence erodes public trust in institutions. When citizens see that laws are written to favor the powerful and that political decisions consistently align with the interests of those who fund campaigns, faith in democratic governance weakens. People begin to perceive the system not as a representative democracy, but as an oligarchy where a small elite exercises outsized control over the direction of the country. The hollowing out of the middle class and the resulting collapse in broad consumer demand is one of the most damaging consequences of decades of economic policy that favored wealth concentration over shared prosperity, The middle class has long been considered the backbone of the American economy, driving growth through its purchasing power and stabilizing society through relative economic security. However, stagnant wages, rising costs of living, and the erosion of secure employment have steadily undermined this foundation. As a result, the ability of average households to buy homes, afford health care, send children to college, and save for retirement has been severely diminished, weakening both economic vitality and social cohesion. Real wages for most workers have barely increased in the past 4 decades, despite significant gains in productivity. The wealth generated by technological advances and global trade has largely flowed to the top, leaving the majority with incomes that do not keep pace with inflation in housing, healthcare, and education. This wage stagnation forces many households to rely on debt to maintain even a modest standard of living. Credit cards, student loans, and mortgages are used as substitutes for adequate income, creating long-term financial vulnerability. When large portions of household income are dedicated to debt repayment, there is less available for discretionary spending, which directly impacts overall demand in the economy, the decline of manufacturing jobs, the weakening of unions, and the proliferation of low wage precarious work have further eroded the economic base of the middle class. Secure jobs with benefits have been replaced by positions offering lower pay, inconsistent hours, and little or no access to health care or retirement plans. This shift has not only reduced income security, but has also made it more difficult for workers to plan for the future or make significant purchases, both of which are essential to sustaining a healthy consumer economy. The housing market, once a pathway to middle class stability, has become increasingly inaccessible. Rising home prices, coupled with stagnant incomes, have pushed home ownership out of reach for many younger families, while older homeowners often face rising property taxes and maintenance costs that strain fixed incomes. Without affordable housing, families are forced to allocate larger portions of their income to rent, leaving less to spend elsewhere in the economy. Healthcare costs have also consumed a growing share of household budgets. Premiums, deductibles, and out-of-pocket expenses continue to rise, even for those with employer-sponsored insurance. Unexpected medical bills can drain savings or push families into debt, further constraining their ability to participate fully in the consumer economy. Education, too, has become a major financial burden, with student loan debt delaying milestones such as home ownership, marriage, and family formation. As the middle class contracts, the economy loses a key driver of sustainable growth. Businesses depend on a broad base of consumers who can reliably purchase goods and services. When that base weakens, companies often respond with cost cutting measures, layoffs, and reduced investment, which in turn exacerbate the very conditions that weaken consumer demand in the first place. This cycle reinforces itself, gradually shifting the economy away from mass prosperity and toward a model where economic activity is increasingly concentrated in sectors that cater to the wealthy, leaving the majority with limited participation in overall growth. The urgent need for public investment and systemic reform arises from decades of neglect in key areas that determine the health, stability, and long-term sustainability of the economy and society. For much of the 20th century, significant public investments in infrastructure, education, healthcare, and research laid the groundwork for economic expansion and upward mobility. Roads, bridges, public transit systems, and energy grids were built and maintained to support commerce and daily life. Public schools and universities provided affordable education to millions, equipping the workforce with skills that fueled innovation and productivity. Public health initiatives improved life expectancy and reduce preventable diseases. Over time, however, the commitment to these collective investments has been eroded, replaced by a belief that private markets can more efficiently meet these needs. The result has been chronic underfunding, decaying infrastructure, and widening disparities in access to essential services. The state of infrastructure across the United States illustrates the consequences of underinvestment. Bridges, water systems, and transit networks are aging far beyond their intended lifespan, leading to inefficiencies, safety hazards, and disruptions in economic activity. Modernizing these systems requires large scale, coordinated efforts that private companies often have no incentive to undertake, especially when profits are uncertain or long term. Similarly, broadband access, increasingly a necessity for participation in the modern economy, remains limited in many rural and low income areas, leaving communities cut off from educational and employment opportunities. Education has also suffered from reduced public investment. Public schools in many areas face overcrowded classrooms, outdated materials, and insufficient funding for arts, technology, and extracurricular programs. Higher education, once affordable for working and middle class families, has become increasingly expensive, forcing students into debt that can take decades to repay. This underinvestment not only limits individual potential, but also hampers the nation's ability to maintain a competitive workforce in an era of rapid technological change. Healthcare, another cornerstone of public well being, remains fragmented and costly. Despite spending more per capita on healthcare than any other developed nation, the United States fails to provide universal coverage, leaving millions uninsured or underinsured. The reliance on employer sponsored insurance ties access to healthcare to job stability, creating vulnerability in times of economic downturn. Public health infrastructure, including hospitals, laboratories, and preventive care programs, has been stretched thin, leaving the country less prepared for crises such as pandemics. Addressing these issues requires systemic reform that reorients economic priorities towards serving the public interest rather than short term private gains. This means not only restoring, but expanding investments in infrastructure, education, and healthcare. It also involves implementing policies that ensure these investments are equitable and reach underserved communities. Tax structures must be adjusted to provide sustainable funding for these initiatives, ensuring that those who have benefited most from the economic system contribute proportionally to its maintenance and improvement. Strengthening labor protections, expanding access to affordable housing, and supporting innovation through public research funding are also essential components of a comprehensive reform strategy that can reverse decades of decline in shared prosperity.